Hello again, my name is Sam. Today we're going to look at a model titled Management and Leadership Understanding of Financial Statements. So the content of this model are divided into the following. Does the balance sheet show what the company worth? The contents of financial statement, the basis of financial accounting, accounting for transactions, elements of financial statement as prescribed by IASB, how to construct financial statement, and there is an example, and the basis or uses of financial statement. Now, what are the key financial statements? Profit and loss statement, which is otherwise known as income statement, and then also the balance sheet. Now, profit and loss statement or profit and loss account tells the performance of the organization or the entity for a period, a particular period. On the other hand, balance sheet shows the entity's financial position at a particular point in time. So whereas income statement or profit and loss looks at the performance of the organization for a particular period, balance sheet shows the financial position at a point in time. So balance sheet has got two dimensions. It's got a dimension that looks at the resources that are controlled by the entity. The other part of this dimension is that it looks at the claim of either the funds providers. You are looking at creditors or equity holders or shareholders. Their claim to this entity. And so this is what balance sheet looks at. The claim made by funds providers and then the resources that the entity controls. So to answer whether balance sheets show the worth of a company, we will say that the balance sheet as well as the profit and loss statement provide specific information. However, it is partial because they do not tell the full story of the present or the future position of the entity. Now, financial statements are prepared based on a set of flexible rules. And to understand or to interpret the financial statement requires a knowledge into these flexible rules. And here, flexible rules, we are looking at the standards based on which the financial statements are prepared. So are the financial statements prepared based on IFRS, that is International Financial Reporting Standards, or is based on the national standard, in other words, the country's standard? These are the rules based on which financial statements are prepared. And so for one to understand this statement, financial statement requires understanding or knowledge of the rules. So what does the financial statement, that is the profit and loss account, contain? What does balance sheet contain? Now, profit and loss statement or income statement provides information for a particular period, the activities of the organization for a particular period. However, balance sheet provides information relating to the resources of an organization and then the claimants to the organization, that is the equity holders and creditors. This information comes at a point. And so whereas balance sheet looks at financial position at a point, the income statement or profit and loss account looks at financial performance for a particular period. As you can see from the diagram, the activities from one point to the other, that is a period, covers the income statement or profit and loss. And so the profit and loss is for a period, whereas the balance sheet is at a point or at a particular point in time. So statement of profit or loss basically looks at the achievement of the organization. What was the revenue by the organization, and then the expenses. So you have your revenue, and then you subtract the expenses, and then you get your profit or loss for a particular period. And so profit or loss statement basically tells you the performance of the organization within a particular period, either 6 months or is for 12 months. What is the structure of the statement of profit and loss? Profit and loss statement can be divided into 3. The first one has to do with the performance of the organization. Then, what should be given or what should be returned to funds providers in the form of finance costs or interest. And then we'll have the returns to the government in the form of taxation. So once you have your performance, you take out the interest that you need to pay to fund providers, excluding equity holders, and then you will be taking out the tax for the government. Now, after taking interest and taking the tax for the government, you are left with profit. Now, this profit is available to shareholders, in other words, equity providers. However, it is prudent that the whole amount or the whole profit is not given to shareholders in a form of dividend. So the common practice is that the profit that is generated after taking interest and tax, part of it will be given or distributed to shareholders as dividend. The other part is then reinvested into the company. So it is added to the company to generate growth into the future. So these are the structure that we have within the statement of profit and loss account. Remember, 1, you need to determine the profit or the performance of the organization. You need to return the part that belongs to funds providers, that is the creditors. You need to pay tax on that. Whatever is left is then shared or distributed partly to the shareholders, and part also goes into the organization for reinvestment. So as you can see from this sample of statement of profit and loss, you can see the performance of the organization up to profit before interest and tax. And then the interest is taken out. Once interest is taken out, tax is computed on whatever is left, and tax is also paid out. Then whatever is left, either profit or loss, is then available for the shareholders. But normally what happens is that part of it is given to shareholders as dividend, and then the chunk of it is normally reinvested into the organization. One item that is found on the statement of profit and loss is what we call operating expenses. Now, operating expenses is captured in the statement of profit and loss in 2 ways. You can choose whichever, either by function or by nature. Now, if it is by function, what that means is that expenses are aggregated under particular function. So, for instance, either expenses are aggregated under administration, distribution, and cost of goods sold. However, if it is by nature, then they are rather grouped under the inputs and then the output, how these expenses are applied. And so these 2 types of operating expenses, any of them can be adopted depending on your conceptual framework that gives you the guideline to prepare your financial statement. So as you can see from this format, the operating expenses have been categorized into function. So we have cost of goods sold, we have distribution, and then we have administration. What happens here is that salaries under administration and other costs, whether depreciation or whatever, if they come under administration, all of them are put together under administration. Distribution, that is selling costs. These also, whether sales commission or salaries or any expenses relating to distribution and selling, are normally grouped under this. And so you see that we don't have individual items like salary, electricity, and so forth, because all of them have been grouped under these major categories under function. So from this format, you see that we've got the two types of operating expenses, under function and by nature. By nature, the various output and inputs are specified, whereas under function, they are grouped under the various departments or the various functions within the organization. Now we look at the structure of balance sheet. Now, balance sheet, has already been said, shows the resources that are controlled by the entity, and then how these resources were funded, who provided the funds. And that is what balance sheet shows. And it is at a particular point in time. And so you have the resources. Here we'll look at the assets and we'll look at the liabilities and then the equity involved. The other aspect of the structure of the balance sheet is the way it is presented. There are two ways that this balance sheet is prepared. One is horizontal, the other one is vertical. So you can prepare your financial statement, that is the balance sheet, either vertically or horizontally. So as we've indicated, balance sheet has got two components, and that is very important. The first one is the resources, and then the second one has to do with the claim at the resources. So the resources are what we term as assets, and the claim can be divided into two. Those from the outsiders, and then those from the company's owners. So with the horizontal presentation of balance sheet, you realize that the resources are on the left-hand side, whilst the claims are on the right-hand side. Now the claim, we are looking at liabilities and we are looking at owner's equity. Liabilities are what has been provided by outsiders, like creditors, banks, and so forth. But the owner's equity is the funds that has been provided by the owners of the organization. And so if you are using the horizontal presentation, all the resources, that is the assets, are on the left, and then the right column has got the liabilities and owner's equity. In addition to what I've just said, the left-hand side, which covers the assets, can also be divided into two, where we have the current and non-current assets. Now, generally, the non-current assets are assets that are controlled over a period of more than 12 months. And so you have both tangible and intangible assets. Tangible assets are those assets that have physical substance, and then intangible assets do not have physical substance. Yet, they are very important to the organization because future cash flows or future benefits, economic benefit, is expected to derive from them. And therefore, it is important that we have these on the balance sheet. The other side of it is non-current assets. Basically, assets that are controlled more than 12 months. Now, we come to current assets. Current assets are those assets that are controlled by the organization within 12 months, so not more than 12 months. Here we are looking at your receivables, we are looking at inventories, we are looking at your cash, because they have to be controlled within the organization within these 12 months. Those that go beyond 12 months, like your PPE, that is property, plant and equipment, your goodwill, your patent, and so forth, they go more than 12 months, so they are classified under non-current assets. The right-hand side consists of provided of funds to the organization. And provided of funds to the organization are equally divided into two. We have those that are going for owners, and then also the providers of funds from creditors. So provided of funds from creditors are what we know as liabilities, and providers of funds from owners is what we call owner's equity. Both of these are on the right-hand side of the balance sheet if you are preparing the horizontal type of balance sheet. So this provided of funds, the priority goes to the liability first, creditors. And so once creditors have been paid, liability is paid, whatever is left belongs to the owners. And that is why we call it residual interest. Even though both parties have got interest in the organization, when it comes to satisfying these groups, we prioritize the creditors first, that is the liability, and whatever is left is then given to owners. And so they take the residual, the leftover, of the resources. So remember, assets, that is the resources, is funded by owners and creditors. But we give priority to the creditors if we have to satisfy them. And once we satisfy them, whatever left goes to the owners. Now, the part of the claim attributable to the owners can also be divided into two. We have those that we call share capital or contributed capital. This is what the owners themselves have contributed to the organization, have invested in the organization. And then we have earned capital, like the retained earnings. This earned capital generally represent what the company has generated from its activities over the years. So whatever profit that the organization has generated that was not distributed to shareholders is reinvested into the organization. So apart from the money that the shareholders or the owners of the organization have contributed to the organization, there is also what the company itself has worked, has performed to generate. And that is what we term as earned. So the component of owner's equity basically is what the owners have contributed. And then we have what we call retained earnings. That is the earned capital, profit accumulated over the years within the organization. So let me give you an example. Let's say a company is set up. The owners will have to invest some money into the business. And so let's say if they invest 10,000 into the business, the entity, the business works or performs to generate, let's say, 2,000 as profit. Now, this 2,000 also belongs to the owners after paying the creditors. And so at the moment, the owner's interest in the organization will be 12,000. However, the 2,000 is what has been earned by the organization. And then the 10,000 will be what the company owners actually invested. And so that is how we differentiate between the two. The share capital is what the owners have contributed, but the retained earnings is the profit that has been accumulated over the years. Now, another element of balance sheet is the liability. Now, the liability has got three main components. The first one will have to be what we call provisions. Now, provisions are liabilities that have been set aside for which the amount and the time is not certain. And so, for instance, if an accountant wants to set aside a provision for warranty, in this case, they expect their customers to claim this warranty on the goods or services that they have provided. This has not actually occurred, but the company will set aside or will make provision. So in case the customers return the goods or the customers claim warranty, then they will be able to pay it. These are a form of provision. So we will have provision for warranty, provision for long service leave. You have also provision for doubtful debt. All these are provisions that have not actually occurred, but you expect them to occur, for which you don't know the time, for which you don't know the amount. And so these are what we call provision. Another component of liability is the financial liability, where you look at the loans from the banks and other financial institutions. Then we have payables as a form of a liability. Payables are what the company owns to the creditors, to outsiders, for which they will have to pay. So all these three forms of liabilities are claims against the organization's resources. The liabilities can also, again, be classified into two: the current and non-current. Remember, the current liabilities are liabilities that have to be paid within 12 months, whereas the non-current will have to take more than 12 months to be paid. So if you take a mortgage or a company goes for a loan for 5 years, that will be classified under non-current liabilities. Whereas accounts payable, because it's expected to be paid within 12 months, will be classified under current liabilities.